Welcome to the Deconstructionist Deep Dive.
The podcast that doesn't just accept the story.
We break it
We examine the pieces.
and expose the machinery inside.
Let's dive in.
What if everything about making money trading isn't just wrong, but is designed to be wrong? Welcome back. For this deep dive, we are turning our analytical focus onto something huge, really. A phenomenon that, well, it extracts billions globally. The trading guru system.
Yeah, it's everywhere.
Exactly. And today we're not focusing on whether one person got lucky or unlucky, no. We are deep diving into the architecture of financial influence.
The system itself.
The comprehensive system that manages to convince millions, literally millions of people, they can routinely beat, like institutional quant funds.
Using just charts and a laptop.
Right. It sounds crazy when you say it like that. So we're deconstructing this whole business model, and we're using analysis of a very prominent figure in crypto and trading education as our sort of specific public case study here.
And our mission for you, the learner, is absolutely critical today. We really want to hand you a kind of critical analysis toolkit.
Yeah, the tools to see through it.
Exactly. So you can spot deception, spot the self-serving stuff, across any financial pitch, really. We're going to deploy the cold lenses of behavioral economics to understand the seduction part.
Why it works on people.
Precisely. Then we're going to hit the system with the, frankly, brutal mathematics of survivorship bias.
Oof. Yeah.
And we'll wrap it all up with a bit of game theory. The goal is simple. Help you cut through all the noise, avoid that feeling of information overload, and crucially, recognize when the system itself is, predatory.
Okay, let's do it. Let's unpack this system, starting right at the foundation, the authority illusion. We have to understand first, how do these figures even build credibility?
Yeah, how do they command trust when, the objective statistics clearly show that active retail trading, it's a losing game for almost everyone.
So we looked at the source material and kind of derived this initial architecture. We call it the authority construction framework. And it's not clumsy, right? It's not some immediate claim of genius.
No, it's subtle.
It's a calculated process, built really through careful credential stacking. The successful guru never just bursts onto the scene shouting, "I'm a genius." They build that credibility layer by layer, often starting, far away from the actual trading screen.
And what's fascinating here, tracing the path of our case study, they start with a really powerful foundation.
Yeah.
Former TV business correspondent role.
Right, for big names, ITN, BBC.
Exactly. Now think about the cognitive transfer happening there. That gives immediate, deep mainstream credibility. It's subtle. It's an implicit nod to institutional trustworthiness, journalistic impartiality, even if it's not directly related to trading skill.
Totally. That's layer one. Mainstream trust. It suggests they're an insider, a credible messenger. Then, boom, they rapidly stack layer two. Personal success stories, often kept quite tantalizingly vague.
Always vague on the details, yeah.
They focus on the results, the outcome, not the messy process or, crucially, the starting capital.
Never the starting capital.
And finally, layer three, the big, bold market prediction claims. This is where the narrative really hardens into, prophecy.
And we're talking specific, headline-grabbing calls, claims of having pinpointed the 2017 crypto market pop, for instance.
Oh yeah, the big ones.
Or demonstrating amazing foresight about the 2008 financial crash. This isn't just, self-promotion. It's narrative engineering. It's designed to project this infallible expertise.
It really is. It's a carefully managed path. It takes a general background in reporting and somehow converts it into perceived, specialized financial expertise.
And then to maintain that authority in today's, super noisy digital world, they use contrarian positioning.
This is key.
They know they can't just sound like every other finance blogger out there. So the guru has to create an US versus them scenario. They position themselves as the sensible, critical voice standing against the extremes.
Right. They'll oppose the crypto gods or the avatars, the ones promising instant Lambos and totally unrealistic returns.
One on the side, yeah.
And then on the other side, they'll criticize the, quote, reckless HO dealers.
Yeah.
The people who just buy and hold and ignore the risks.
So they look like the reasonable middle ground, the voice of sober trading discipline.
And that, you see, that's the brilliant, subtle paradox, isn't it? They claim they're offering this unique, superior path, totally separate from the institutional herd.
Oh.
But they often adopt the exact same, highly conventional, sometimes really outdated technical analysis principles that institutions themselves use.
Just dressed up differently.
Exactly. Dressed up with a more rebellious kind of anti-establishment story. They tell you they've got the secret to beat the system while basically using the system's oldest playbook.
Okay, so the authority's constructed. Now the guru shifts gears. They start using the emotional trigger matrix. And this is why the message hits so hard, especially for the retail investor.
Yeah, the psychology of it.
Because if you're coming to this stuff, you're often doing it because you're under financial stress, right? Or feeling anxious, or maybe that paralyzing fear of missing out.
Oh, no. Yeah.
And the guru is expertly poised to pull those psychological levers.
The sources, they really reveal the powerful use of fear and anxiety. They use these hyper-relatable, high-stakes scenarios.
Yeah.
Think about those anecdotal mortgage stories you sometimes hear.
Oh, yeah, the wife's going to kill me stuff.
Exactly. I was about to lose the house. Or my wife's going to kill me if I don't figure this trading thing out. It creates this immediate, desperate urgency for salvation.
And they have the answer.
They're offering the life raft their system from what feels like a terrifying personal financial disaster. And that emotional leverage, it just bypasses rational scrutiny completely.
And tied right into that desperation is the just irresistible promise of secret knowledge or an informational edge.
Right, the I know something you don't angle.
They claim to condense, get this, 200 years of accumulated trader experience. I mean, what does that even mean?
It sounds impressive, though.
It sounds vast, intimidating. And they condense it into an accessible, short, maybe 3-day format or a simple book. This gives the learner a perceived advantage, that feeling that they're now privy to something the masses, maybe even the institutions, don't fully get.
Which is often immediately followed by the confessional narrative and dependency loop. This one's clever.
Very.
The guru publicly admits to early, painful failures, like, oh, I lost a fortune in the .com crash.
Right, builds authenticity, makes them seem human.
Exactly. The learner thinks, okay, they're real, they failed, they learned through the fire, and now they're sharing their hard-won wisdom with me.
But that vulnerability is actually a critical mechanism of dependency. The implicit message is crystal clear. I already walked that painful 7-year road, so you don't have to.
So you need them.
It makes the dependency relationship complete. The learner feels they need the guru to interpret and translate that long, painful learning period into an easy system, because the alternative is facing the scary market uncertainty alone.
And finally, that psychological urgency leads straight into scarcity. By claiming they can radically shorten the supposed 7-year learning curve down to weeks or months.
Which sounds amazing if you're stressed about money.
Right. They exploit the learner's avoidance of opportunity cost. The pressure becomes immediate. If you don't buy this system now, you are literally losing money on every profitable trade you could have made during the time you waste searching elsewhere.
Time itself is weaponized against your bank account.
Brutal.
Okay, so we've laid out the intricate psychological framework. Now, we absolutely have to look at the hard financials. This is where the stated altruism just collides head-on with the reality of layered profit extraction.
Well, follow the money.
We need to systematically map out the actual income sources and contrast them sharply with that narrative of just sharing knowledge. This is the revenue stream hierarchy.
And the stated philosophy, it's almost always framed around giving back, isn't it? I didn't do it for the money, or I really want to help the little guy finally succeed.
You hear that all the time.
But the reality is, the actual business model is layered, it's highly scalable, and, let's be honest, immensely profitable.
So let's start at the bottom of the pyramid, the primary revenue. This is the base product, right? Designed for mass appeal, low-friction sales. Think book sales like the crypto trader in our case study.
The entry point.
Exactly. And this revenue gets facilitated and scaled by major partnerships, publishers, distributors like Amazon, Harriman House. This provides a stable, scalable income base.
Yeah.
And crucially, it enhances that external credibility. Again, now you're a published author, not just some guy on Twitter.
Good point. It adds another layer of legitimacy.
Yeah.
Then you escalate, right, into the secondary and tertiary streams.
Yeah, now we're talking passive income from social media monetization, generating huge traffic from massive Twitter followings, like the @Glen Goodman example.
Millions of followers.
High-value speaking fees at conferences, premium content subscriptions, maybe advanced, very expensive mentorship courses.
This is all direct monetization of the audience they've built.
Absolutely. But here's the really essential analysis and where the contradiction truly bites the hidden revenue.
Okay, what's that?
Our deep dive sources consistently point towards a critical, often undisclosed stream potential affiliate relationships with spread betting platforms, often in things like Forex or crypto futures markets.
Ah, so if I sign up to trade using their link.
They might get a kickback.
Yeah,
And if we connect this to the bigger picture, this is the definitive conflict of interest, isn't it?
totally.
If the guru profits not just when you succeed and buy their book, but potentially when you trade, or even worse, sometimes when you lose, depending on the platform deal,
Oh, wow.
then their paramount incentive isn't your long-term success. It's maximizing the sheer volume and frequency of trading activity among their followers.
They benefit from the churn, from your transaction costs.
Exactly. And that collision brings us squarely to the business model contradiction. How can any system claim to be altruistic while simultaneously monetizing the very inefficiency it claims it can help you exploit?
This is the core logical flaw, isn't it? It has to be addressed. If the guru truly possesses a uniquely effective, reliable system for exploiting market inefficiencies, something they could genuinely use to get incredibly wealthy.
Why aren't they just doing that?
Exactly. Why on earth are they spending all their time writing detailed books, managing complex social media engagement, running customer service for courses, instead of simply executing that amazing strategy at a massive institutional scale themselves?
This is the critical insight we call knowledge arbitrage. It's the act of monetizing information about markets that are, at least theoretically, efficient.
Which ties back to the efficient market hypothesis EMH contradiction. The EMH basically suggests that, broadly speaking, current prices reflect all available information. Now, if the market were really inefficient enough for some simple technical system to exploit easily and reliably,
The most profitable thing to do would be to execute that strategy with billions of dollars, right? Not sell the secret for, what, a few $100 in a book?
precisely. The moment the secret is sold widely, the supposed efficiency diminishes anyway. The edge gets arbitraged away by everyone trying to do the same thing.
So the only person guaranteed to profit,
Is the seller, who successfully monetized the information asymmetry before it disappeared.
and the contradiction looks even starker when you place the guru's system against other, more established financial approaches, using the comparative framework.
Right, let's compare. The guru approach is almost always short-term, isn't it? Based purely on momentum price action.
Relies heavily on anecdotal evidence, focuses entirely on price prediction.
Okay, contrast that sharply with, say, traditional investing, which mandates a long-term time horizon, right? Uses underlying business fundamentals like, what does a company actually do, as the basis for value.
And relies on decades of historical data, not just recent charts.
Or compared to academic finance, which focuses rigorously on systematic risk factor exposure, verifiable systematic strategies, and absolutely mandates peer-reviewed research.
The guru model. It just lacks the necessary statistical rigor. It lacks the logical coherence when you put it next to these established frameworks. It looks flimsy.
It really does. Okay, now let's take the scalpel, as we say, and apply it directly to the core axioms, the fundamental beliefs of technical trading itself.
Yeah.
Because these systems rely on assumptions about how modern markets work that are, frankly, decades out of date.
Yeah, the market structure has changed fundamentally. Let's begin with axiom 1. Markets as pure psychology. You hear this all the time in the guru materials.
Oh, yeah. Charts work because humans are humans.
Algorithms are taught by humans. That whole line. The core idea is that human emotion, fear, greed, remains the primary exploitable factor driving short-term price moves.
But that statement is just profoundly wrong today. It completely ignores the massive structural market changes over the last, say, 15 years. It's fundamentally vulnerable because of the rise of high-frequency trading, HFT, and general algorithmic dominance.
The reality check is stark. We're talking about, what, upwards of 60%, maybe more, of daily trading volume being driven by automated machines.
Machines, running algorithms, executing trades in microseconds. These systems don't suffer from fear or anxiety or, mortgage concerns.
None of that. A human looking at a chart is trying to spot a pattern based on historical human reactions, right?
Right.
An HFT algorithm. It's reacting to order flow, liquidity dynamics, tiny latency differences across exchanges at speeds that just make human pattern spotting totally irrelevant for short-term moves.
So the human is trying to predict the emotions of a machine that literally has no emotions.
Pretty much. The mathematical flaw here is clear. The axiom assumes these persistent behavioral patterns that a chart reader can spot again and again reliably.
But the players change.
Exactly. The population of market participants is constantly changing, not just the individuals, but the proportion of machines versus humans. And decision-making is increasingly automated. That edge you thought you had reading human psychology, it's being systematically arbitraged away by faster, unemotional machine intelligence.
Okay, so that failure to adapt leads right into axiom 2. The myth of universal technical patterns. Gurus, including our case study, love citing specific examples to prove patterns work.
Oh yeah, they'll pull out the chart of the rounded top pattern that supposedly predicted the 2008 crash, like it's definitive proof.
And that successful instance, I mean, it sounds incredibly powerful when they present it like that. But you, the learner, must recognize this for what it is. The textbook definition of survivorship bias.
This is the devastating statistical flaw right at the heart of chart reading. There's that classic example from World War II, right? Analyzing bombers coming back from missions.
Yeah, the bullet holes.
Analysts noted where the planes had bullet holes, thinking, okay, we need to reinforce these areas. But the real insight came from realizing they should reinforce the areas where the returning planes had no holes.
Because those hits must have been fatal. Those planes didn't come back.
Exactly. Similarly, gurus are only remembering and highlighting the confirming instances, the patterns that worked, like that 2017 top call. They are systematically ignoring the thousands, maybe tens of thousands, of false signals or failed pattern attempts that happened in between.
Which, like the planes that never returned, are statistically invisible to the anecdotal chart reader. You just don't see the failures.
They show you the one successful prediction, but they conveniently omit the rigorous statistical analysis required to validate it. There's a total lack of methodological rigor.
No independent testing.
None. No statistical significance testing of pattern reliability over large data sets. We don't see formal backtesting done correctly where you test the strategy on data it hasn't seen before.
If you can't prove that your pattern works significantly better than just random chance across a massive, statistically valid data set, then it's just an anecdote.
Yeah.
It's storytelling dressed up as analysis.
And that brings us to axiom 3, the cut losses panacea. This is the one rule everyone repeats, delivered with such solemn confidence. Cut your losses short. Let your winners run.
Sounds like solid common sense, right? Disciplined.
It does. But for the retail trader, actually applying it has these crippling hidden costs that gurus rarely, if ever, talk about.
Okay, like what?
Well, the gurus fail to detail the hidden costs for someone trading frequently, especially on platforms dealing in crypto or Forex. The cumulative transaction fees, the commissions,
And the spread.
and the bid-ask spread. That difference between the price you buy at and the price you can immediately sell at, these costs are often opaque, but they are enormous friction. They just eat away at small gains relentlessly, potentially wiping out any tiny edge the system claimed to have.
And then there are taxes.
Oh yeah. Beyond transaction costs, you face significant tax implications from high-frequency short-term trading. Capital gains tax structures often punish short-term speculation much more heavily than long-term investing. That severely reduces the real spendable profit the guru promised you.
And furthermore, they almost entirely ignore the psychological reality of trying to follow that rule. The gurus promise discipline, but basic human psychology is dominated by loss aversion.
We hate losing more than we like winning.
Exactly. Most retail traders fundamentally struggle with realizing a loss. Selling a losing position means admitting you were wrong. That's psychologically painful.
So that friction often leads to traders just abandoning the systematic approach entirely. Or worse, engaging in erratic, emotional revenge trading that completely destroys any systematic edge the guru might have claimed existed in the first place.
So this whole structure, this doctrine, it's built on a foundation of missing professional methodology. We really need to catalog the critical missing elements, things that are absolutely required in any professional trading fund, but are just completely absent from the guru systems being sold.
Okay, what are the big omissions?
Think about what professional risk management absolutely demands. It requires sophisticated position sizing mathematics, often using formulas like the Kelly criterion.
Sounds technical.
It is a bit, but it's basically just a mathematical formula. It helps determine the optimal percentage of your capital to risk on any single trade to maximize your long-term growth while avoiding catastrophic ruin.
Wow.
Gurus don't teach this properly. They teach gut feelings or simple arbitrary percentage rules like risk 1% per trade.
Which isn't tailored to the odds or your specific situation. They also omit crucial risk controls like portfolio correlation management. This is essential to manage systemic risk.
Beauty.
It means not just buying different things, but buying assets that tend to perform independently of one another. So if one part of your portfolio tanks, the whole thing doesn't implode.
Diversification that actually works.
Right. And critically, they skip dynamic market regime detection and adaptation. Your strategy has to be radically different when the market is going wild, highly volatile, a high volatility regime, compared to when it's just moving slowly and predictably, a low volatility regime. Gurus often push one system for all conditions.
Which is dangerous.
Very. And finally, they neglect the full transaction cost incorporation into the strategy itself. Meaning, they don't calculate if the strategy is actually profitable after you deduct all the fees, the spreads, the taxes.
The real-world costs.
And of course, the necessary statistical validation procedures. If you haven't validated it rigorously, if you haven't calculated your potential maximum drawdown, if you haven't proven statistical significance, you're not trading, you're gambling.
Oh.
Regardless of how pretty the charts look. Okay, moving outwards now. We need to look at the larger structural and, frankly, mathematical flaws that basically guarantee that selling trading success is a path to systemic decay for the followers, even if the system maybe, briefly, worked for the guru themselves way back when.
The system eats itself.
Pretty much.
Yeah.
Let's start with the epistemological flaws, or as we like to call it, the self-fulfilling prophecy trap. This gets a bit philosophical, but it's critical.
Okay, lay it out.
Technical analysis claims it can predict market psychology, right? What the human mass, the crowd, will do next based on historical patterns.
That's the premise.
But the crucial realization today is that markets increasingly consist of, well, technical traders, people following similar systems, reading the same books, maybe even subscribing to the same guru.
Ah, so the predictors are becoming the predicted.
Therefore, technical analysis is increasingly just predicting itself. It creates this powerful self-referential or reflexive loop. When enough people buy the book and start trading based on, say, the rounded top pattern.
That pattern only works because everyone is looking for it and piling in based on it simultaneously.
Exactly, which leads to the devastating and unavoidable result. Diminishing predictive power as adoption increases. The more successful the guru is at selling their system to the masses,
The less effective that exact system becomes for every single new follower. It gets arbitraged away by its own popularity.
and the seller, having monetized that initial, maybe fleeting edge, they just move on to sell the next system or course, leaving the followers holding the bag, grappling with the now efficiently exploited, useless pattern.
Okay, now for the cold, hard, quantitative reality check. The scale fallacy. Guru success stories consistently, conveniently omit factors that are absolutely critical if you, the listener, want to translate their supposed success into your life and your bank account.
They leave out the crucial context, like the omitted factors, the fact that the guru was likely trading this stuff full-time, with total dedication, whereas the retail learner is probably juggling it part-time after their day job, stressed and tired.
Big difference.
Huge. They omit the actual starting capital amounts they began with, which often required substantial family help or maybe other income streams. They don't talk about their sophisticated early use of high leverage, which magnifies gains and losses.
Or the fact they probably had significant financial cushions during that required long learning phase where they were likely losing money.
Things the average person starting out just doesn't have. And the mathematical contrast is the most brutal element that's routinely obscured. Let's quantify this because it matters.
Yeah, put numbers on it.
A 10% return on a starting capital of, say, $1 million allows for a radically different lifestyle outcome and a totally different risk tolerance than a 10% return on $10,000.
Right.
On $1 million, 10% is $100,000. That's potentially a sustainable income, right? But on $10,000, 10% is just $1,000, which is probably not even enough to cover the trading fees and taxes, let alone justify the massive time commitment and emotional roller coaster.
So gurus use the high percentage gains to get you excited.
Exactly. But they obscure the absolute dollar reality that actually determines survival and success for the small-scale trader trying to make a living from this.
In all of this whole sophisticated manipulation, it's built on exploiting fundamental human flaws, isn't it? Let's just quickly summarize the main cognitive biases exploited that make the guru narrative so damn seductive and sticky.
Okay, first, the narrative fallacy. The guru sells this clean, linear, easy-to-follow success story. I followed the steps, I learned the secret, I got rich. You can too.
Right, the hero's journey.
But it surgically masks the messy, volatile, often 7-year-long struggle period that the sources actually mentioned, the real messiness, the anxiety, the failures, that is all edited out to create a neat, digestible, sellable product narrative.
Then there's authority bias, which we touched on earlier. This is that mental shortcut where we automatically give more weight to opinions from an authority figure, even if it's outside their actual expertise.
Like using the past TV background, it provides this deep, implicit credibility shield. It transfers your trust in, say, the BBC to trust in their personal trading system.
Your brain just takes a shortcut. I trust the news anchor, so you implicitly trust their unrelated financial advice.
And finally, the systematic deployment of confirmation bias. They constantly highlight only the correct, successful predictions. See, I called the 2017 crypto top while systematically obscuring or just ignoring all the missed calls, the wrong predictions that inevitably happen in between.
So the learner only ever sees the wins, which confirms their belief in the system's magic. They never see the complete, messy track record.
And all this synthesizes powerfully into what we call the control paradox. The entire guru marketing engine promises you a comprehensive system designed to allow you, the retail trader, to finally control and profit from these fundamentally unpredictable markets.
But the core undeniable truth remains, doesn't it? The markets are, at their base, structurally and fundamentally unpredictable, especially in the short term, and certainly way beyond the consistent predictive reach of a retail trader using basic charting tools against HFTs.
So the result is, well, it's deeply cynical. The system delivers the illusion of control. And that illusion is something people under stress are often very happy to trade their money for, even if it leads to consistently suboptimal financial outcomes.
And that illusion establishes the dependency cycle. The guru promises you ultimate financial independence, right? Learn my system and be free.
But that very promise requires your ongoing purchase of their next system, their premium content updates, their constant interpretation of what the market's doing now. You become perpetually dependent on the very person who promised you liberation.
Wow. It's a perfect trap. Okay, we've thoroughly broken down the machinery. We've exposed the structural flaws, the psychological traps, the economic contradictions. Now let's talk about how you, the listener, can actually liberate yourself from this and what truly robust, evidence-based alternatives actually look like.
Yeah, the positive path forward.
We start with the guru evaluation framework. Think of this as the critical protocols, the checklist you absolutely must use on any financial system promoter, any expert selling you secrets. You have to demand evidence, not just anecdotes.
Okay, protocol number 1, the transparency test. Is there full disclosure of their actual positions, their trades, their returns? And crucially, is that trading activity tracked and verified in real time by a credible, independent third party?
Right. Anecdotal screenshots of amazing wins. Completely worthless without independent verification.
Protocol 2. Rigorously enforce the scale disclosure requirement. Are the actual account sizes they're trading with and the leverage they're using clearly and honestly stated?
We have to get past the percentage game. Is it 10% on $1 million or 10% on $1,000? Because that difference fundamentally changes the real-world viability of the advice for you.
Absolutely. Protocol 3, demand time verification. Is there a multi-year track record? And we mean like 10 years or more, minimum, verified.
Anything shorter, especially in volatile markets like crypto or Forex, is just statistical noise.
Yeah.
It could easily be pure luck, a random hot streak.
Yeah.
Not skill.
Protocol 4, methodology rigor. Is the approach they're teaching actually peer-reviewed? Is it statistically validated by independent academic-level research? Or is it just based on their personal experience and cherry-picked examples?
And finally, the absolute non-negotiable. The conflict disclosure must be complete and transparent. Are all revenue streams, especially those potentially hidden affiliate relationships with brokers or spread betting platforms, clearly and explicitly stated up front?
If the answer to any of these critical questions is no, or it's complicated, or they get defensive, you have to just walk away immediately.
Okay, so instead of this high churn, high cost, high stress speculation game, let's pivot. Let's talk about robust, evidence-based alternatives. These are, admittedly, the duller, less glamorous approaches.
Yeah, they don't promise Lambos tomorrow.
But they are statistically superior, derived from decades of serious academic financial research and proven long-term investing principles.
This centers on evidence-based portfolio construction. Forget trying to time the market or pick winning chart patterns. We're talking about things like globally diversified market capitalization weighting.
Which basically means owning a tiny slice of the whole world's economy systematically.
Exactly, and implementing systematic rebalancing protocols. This is the core of philosophies like the Bogleheads approach, emphasizing keeping costs incredibly low and achieving the widest possible diversification. Don't look for the needle, buy the haystack.
And beyond that broad diversification, you can consider strategic factor tilts. Now, this sounds highly technical, but the concept is pretty straightforward.
It just means systematically increasing your exposure to proven risk factors that have historically generated superior long-term returns, as identified by Nobel Prize-winning research like the FAMA French models.
So instead of trying to guess where the price of one specific stock or coin will go next,
You're systematically tilting your entire portfolio towards broad groups of stocks that share characteristics which academic research has shown tend to outperform the overall market over the long run. Things like small cap stocks, value stocks, stocks with strong momentum, or high quality companies.
you're capturing known systematic risk premiums that have historically paid off, not chasing some fleeting pattern on a chart.
The core principle here is totally different. It's about maximizing genuine, sustainable returns by focusing relentlessly on minimizing costs, achieving broad market exposure, and capturing long-term economic growth, rather than trying to outsmart millions of algorithms minute by minute in what's essentially a zero-sum or even negative sum after costs game.
You embrace the academic framework, you embrace the wisdom of low costs and patience.
And this brings us back, in a way, to the entrepreneurial alternative, which really exposes the ultimate contradiction in the trading guru's own career path.
Yeah, Goodman's contradiction, as the source calls it. It's central. He advocates constant market participation, endless speculation.
But his actual, reliable, controllable success came from building an information business, selling knowledge. He created tangible value by publishing books, generating courses, building a media platform, not purely by relying on the chaotic whims of market volatility.
So the truly superior path for you, the learner, the one that offers genuine control, is often about direct value creation, building business, however small, or increasing your own human capital value, acquiring new, high-demand skills that make you more valuable in the economy.
Business ownership or valuable skills provide a level of control over inputs, service, pricing, output that is entirely absent in the world of short-term market speculation. You build value, you don't just bet on price changes.
So let's wrap this up. We leave you with the cognitive emancipation principles. To achieve true, robust financial sovereignty, you have to fundamentally reject the need for any guru to interpret market reality for you.
Take back control of your own thinking. Demand rigorous statistical proof, not charismatic stories or cherry-picked anecdotal successes.
And finally, adopt a value orientation. Focus your precious energy, your time, your capital on creating measurable value in the real world, whether it's a business, a skill, a product, a service, rather than just speculating on price movements in an unpredictable, friction-filled digital environment designed to extract fees from you.
And that's our deep dive for this week.
Remember, the most dangerous illusion is the one you don't know you're in.
But now you know. So here's our question for you. So we've torn apart the trading guru system. Now the real question is, what is the one financial truth you've held onto that you're finally ready to put on the chopping block?
Let us know in the comments. Question the narrative, deconstruct the dogma, see the system.
We'll see you next time. Stay skeptical. Thank you for joining us.